In the upper echelons of global finance, there is a term known as the asset of last resort. When missiles start flying, when sudden sanctions freeze every bank account you own, and when your national currency evaporates 30% of its value in a single night, that is exactly when gold speaks. Right now, Turkey is selling, Russia is liquidating, Poland is considering the unthinkable. To the casual observer, it looks like a collapse, but this is not a retreat. This is the moment the ultimate weapon is drawn from its scabbard. If you've been watching the headlines lately, you've probably seen the red tickers. Central banks are dumping gold. The gold bull market is over. It sounds devastating, doesn't it? It makes you want to question everything you thought you knew about hard assets. Why on earth would the world's most powerful financial institutions sell their most precious insurance policy at the exact moment global instability is peaking? Did they lose faith, or did we miss the most important lesson in monetary history? Today, we are going beyond the surface-level panic. I'm going to decode the defense mechanism of gold, a strategic reality that mainstream headlines are either ignoring or simply don't understand. We're going to look at why selling gold in this specific context is actually the ultimate proof of its success. By the end of this video, you won't just see a price chart, you'll see a battlefield. Let's dive in. To understand why selling gold is actually a testament to its power, we have to look at what is happening right now in Ankara and Moscow. The headlines tell you that Turkey has drawn down approximately 60 tons of gold since the conflict began. That is roughly $8 billion worth of bullion hitting the market. To the average investor, that looks like a lack of confidence, but in reality, it's the exact opposite. You see, Turkey is facing a brutal currency crisis. The lira has hit record lows 11 times in just the last few weeks. At the same time, the conflict in the Middle East has sent oil prices surging toward $100 a barrel. Now here is the mechanical trap. Energy is priced in dollars. When oil spikes, energy-importing nations like Turkey, India, and much of Europe suddenly need a massive, immediate supply of greenbacks to keep the lights on. When your currency is collapsing and you need dollars now, what do you sell? You can't sell your long-term treasury bonds easily, not when yields are approaching 5% and the market value of those bonds is underwater. If you sell them now, you take a massive capital loss. You can't sell your infrastructure. You can't sell illiquid foreign equities into a war-driven downturn. So you reach for the one thing that actually works in a genuine crisis. You reach for your gold. This is the concept of liquidity of last resort. Gold is the only reserve asset on the planet that you can liquidate at size, with incredible speed, and without counterparty risk. Turkey isn't selling because they think gold is overvalued. They're selling because gold is the only asset that held its value well enough to be worth liquidating. It is performing the exact function it was bought for, protecting the nation when every other door is slammed shut. Then we have Russia. Moscow has been liquidating gold for months to fund its ongoing war efforts. Since 2025, they've raised billions by drawing holdings down to a 4-year low. Again, the mainstream narrative screams failure, but look closer. This isn't portfolio repositioning, it's war financing. If Russia didn't have that gold, their economy would have likely seized up under the weight of global sanctions a long time ago. The irony here is extraordinary. These countries are using gold to survive the very geopolitical instability that drove them to buy gold in the first place. It's a circular logic that few people grasp. Gold isn't failing the test, it is passing it with flying colors. It is providing emergency liquidity when the dollar system becomes a weapon of war or an inaccessible luxury. But if gold is so liquid and so reliable, why are we seeing such violent price swings on our screens? Why does the price drop 10 or 15% in a month if the central banks are just using it as intended? To answer that, we have to stop looking at the physical bars in a vault and start looking at the digital paper market. Because while Turkey is using gold to defend a nation, others are using it to gamble on a screen, and that is where the real volatility begins. To understand how this digital house of cards impacts your physical holdings, we need to look at a classic financial model that most people have never heard of, the Exter's liquidity. But why gold? Not real estate or high-growth tech stocks or even the most stable corporate bonds. The answer lies in a classic diagram that has survived for decades, John Exter's liquidity pyramid. If you want to understand how money actually moves during a crisis, you have to visualize this inverted pyramid. At the very top, the widest and most unstable part, you have derivatives and unfunded liabilities. This is the world of paper wealth, valued in the hundreds of trillions. Below that, you have private equity, real estate, and the stock market. As you move down the pyramid, the assets become less risky, but also less plentiful. At the very tip, at the bottom of the structure, sits gold. John Exter, a former central banker himself, designed this to show one thing. In a period of systemic expansion, everyone moves toward the top of the pyramid, chasing yield and taking on leverage. But when the music stops, when war breaks out, or the debt bubble reaches its limit, the entire process reverses. It's called a flight to liquidity. Money begins to cascade downward. It leaves the speculative tech stocks. It leaves the over-leveraged real estate. It even leaves the government bonds if the yields are too volatile. Everyone is scrambling for the exit, trying to move their wealth into narrower, more stable layers.
Eventually, all that massive weight from the top tries to squeeze into the tiny point at the bottom, physical gold. This is why gold's price can be so violent. You have a trillion-dollar ocean of paper wealth trying to pour into a billion-dollar cup of physical metal. The math simply doesn't work without a massive repricing. However, there is a catch, and this is where most retail investors get hurt. In modern markets, there is a massive distinction between owning gold and renting gold. When you see the price of gold drop 5 or 10% in a few days, you aren't seeing people throw their physical bars out the window. What you are seeing is the paper market collapsing. This is the world of leverage. Right now, retail and institutional leveraged buyers make up a significantly larger share of the market than they did just 2 years ago. These people aren't investors, they are gamblers, renting exposure to gold's price. When gold's 180-day volatility spikes, which it has, reaching levels not seen since 2006, these leveraged players get hit with margin calls. They don't choose to sell, they are forced to sell by their brokers to cover their debts. This creates a mechanical, cascading liquidation. One forced sale pushes the price lower, which triggers the next person's margin call, which forces the next sale. It's a domino effect that has nothing to do with the fundamental value of the metal. But if you own the physical metal, real allocated gold in your name, nothing has changed. You still have exactly the same number of ounces you had in January. Your foundation at the bottom of Exter's pyramid is still solid. In fact, this washout of the leveraged paper players is actually healthy. It clears out the weak hands and resets the market on a far more sustainable footing. So if the current volatility is just a mechanical flush-out of the gamblers, and the central banks are only selling because they have to survive, does that mean the bull market is over? Or are we simply repeating a pattern we've seen before? To find the answer, we have to look back at the 1970s, a time that looks frighteningly similar to today. History doesn't repeat itself, but it often rhymes. If you're feeling uneasy about the current price action, we need to go back to 1974. At that time, the world was in a state of chaos quite similar to ours. Inflation was rampant, geopolitical tensions were boiling, and gold had just finished a massive run from $35 to nearly $200. Every headline at the time was shouting that gold was the only place to be. Sound familiar? But then, something happened that broke the hearts of many investors. Between 1974 and 1976, gold didn't just dip, it crashed. It suffered a brutal 44% drawdown. The experts on TV declared the bull market dead. They laughed at the gold bugs. They said the gold bubble had finally burst and that the world was moving on. They were wrong, spectacularly wrong. That 44% drop was nothing more than a mid-cycle correction, a massive flush-out of weak hands before the real move. From that low, gold went on to quadruple, eventually hitting $850 in 1980. The lesson? A violent correction in a bull market is not a sign of its end. It is a sign of its maturity. Fast forward to today. We've seen gold move from $1,800 to over $5,500 in just 3 years. A 20 or 25% correction from those highs isn't a collapse, it's math. It's what healthy bull markets do to reset the sentiment. But there's a massive structural difference between 1974 and now that actually makes the bull case for gold even stronger today. In the 70s, the U.S. debt-to-GDP ratio was around 35%. Today, it is over 120%. Back then, the U.S. was running manageable deficits. Today, the U.S. is running emergency-level deficits during a period of supposed economic growth. Right now, long-term bond yields are approaching 5% because the government needs to borrow more, not less. And here's the kicker. Poland isn't proposing to sell gold because gold is a bad asset. Poland is proposing to sell gold because it's the only asset they can tap for defense spending without taking on more debt or bowing to EU fiscal conditions. Think about that for a second. In a world drowning in debt, where the risk-free return on bonds is being questioned, gold is the only asset that provides a clean exit. It is the only asset that doesn't require a signature from a banker or a politician to be valuable. The selling we see from Turkey or Russia isn't a rejection of gold's thesis. It is the real-time proof of it. They are using their insurance because the house is on fire. If you are watching the 4-week price chart and panicking, you are missing the forest for the tree.
The reason central banks began buying 1,000 tons a year in the first place, the weaponization of the dollar, the frozen reserves, the unsustainable debt levels, none of those have gone away. In fact, every single one of those drivers has intensified in the last month. This is a bull market taking a breath, not a bull market ending. But even if you believe in the long-term macro picture, there was a very real floor to the price of gold that the paper traders often ignore. It's a physical, industrial reality that prevents gold from ever hitting zero. To understand where the true bottom lies, we have to look at the dirt. We have to look at what it actually costs to pull an ounce of gold out of the ground in 2026. While the paper market is driven by fear and algorithms, the physical world is driven by a very different metric, the cost of production. To find the ultimate bottom for gold, we have to look at what it actually takes to pull an ounce of metal out of the earth in 2026. In the mining industry, there is a crucial number called AISC, all-in sustaining cost. This isn't just the cost of digging a hole, it includes everything: energy, labor, taxes, the cost of replacing equipment, and the massive capital needed to discover new deposits. If you look at the data from the industry giants, companies like Newmont and Barrick Gold, a startling reality emerges. Over the last few years, AISC has been skyrocketing. Why? Because the easy gold is gone. We're digging deeper, moving more tons of rock for less yield, and doing it in an environment where the price of diesel, machinery, and specialized labor has surged due to global inflation. Right now, the average AISC for a major global miner is hovering between $1,300 and $1,400 per ounce. In some high-cost regions, it's even higher. Why does this matter to you as an investor? Because it creates a physical floor for the price. Think about the difference between gold and the dollar. The cost to print a $100 bill is practically zero. If a government wants to devalue it by 50%, they just press a button. But you cannot print gold. If the market price of gold ever dropped below the AISC for a sustained period, mines would simply stop digging. Supply would dry up almost instantly, creating a massive shortage that would force the price back up. Gold has a natural industrial gravity that prevents it from ever hitting zero. It is an asset that requires real work, real energy, and real risk to bring into existence. And here is the kicker. Global supply has not kept pace with demand. New discoveries are at multi-decade lows. The time it takes to bring a new mine from discovery to production is now averaging 10 to 15 years due to environmental regulations and geopolitical instability. So let's look at the full picture we've built today. On one side, you have structural demand drivers that are only getting stronger. Central banks buying because they have to, a world drowning in unsustainable debt, and a geopolitical map that is fracturing before our eyes. On the other side, you have a constrained supply and a rising cost of production that provides a hard floor underneath the market. In between, you have the noise, the leveraged traders getting liquidated, and the emergency sales by countries in crisis. When you zoom out and look at these two massive forces, unstoppable demand and constrained supply, you realize that what we are seeing in the 4-week chart isn't the profile of a bull market ending. It is the profile of a bull market taking a necessary breath before the next leg up. Everything we've discussed today leads to an inevitable conclusion. It's not a question of if gold reasserts its role in the global system, but when. The question isn't, are central banks selling? Yes, some are. The question is, are they selling because the thesis has changed or because the thesis is being proven in real time? I think the answer is now pretty obvious. So where does this leave us? When you see the headlines screaming about central banks selling their gold, don't look at it as a failure of the asset. Look at it as the ultimate validation. Central banks aren't selling because gold has lost its luster. They're selling because gold is the only thing they have left that actually works when the world is on fire. It's the asset of last resort, doing exactly what it was designed to do, providing a lifeline for nations when the dollar system is blocked or their own currencies are in freefall. The volatility we see today is merely the noise of a changing global order. Between the mechanical liquidations of the paper market and the physical floor of mining costs, the long-term structural bull case for gold has never been more obvious. The debt is still growing, the geopolitical fractures are deepening, and the need for an asset without counterparty risk is only becoming more urgent. The central banks have already drawn their weapons of defense to protect their national sovereignty. Now, the real question is for you. Have you secured your own defensive weapon for your portfolio? Do you have a foundation that can withstand the cascading waves of the liquidity pyramid? I want to hear from you in the comments below. Given everything we've decoded today, do you believe gold will reassert its dominance and touch the $6,000 mark before this year is over? Or is there another factor the market is missing? If you found this analysis valuable, hit the like button and subscribe to the channel so you don't miss our next deep dive into the global macro shift. I'll see you in the next one.